Okay, in today's interview, we have the one and only Rick Rule. Now, Rick is, of course, if you're unfamiliar, one of the most famed and successful natural resource commodities, gold, silver investors. And I'd also liken you to a philosopher as well. So one of the top in the world. So, we're really privileged to have the opportunity to learn from Rick today. So I do want to say a couple quick announcements. Number one, Rick does do a free review on your stock portfolio. The link to that is in the description right there down below. So if you send your natural resource portfolio, he'll go back and forth and he'll give you a little review for free on your portfolio. So the link's down there below. I want to encourage everyone to hit the like button on either side to send this out to more people. Give us your gold price prediction for 2021 in the comments right there down below. And last but not least, just a shout out to our show and channel sponsor, Vizsla Resources. And so thank you, Vizsla, for being a silver stock and our channel sponsor. And welcome, Rick Rule.
A pleasure to be with you, Jake. I've enjoyed our conversations.
Okay, so let's start here. What's going on in the world? What's going on in the economy? What's going on in metals? And what are your expectations?
Boy, you start small, don't you?
Nah, I like to start small.
The world is, as you describe it, fairly complex. It isn't only the United States that's going through change. One notes that Angela Merkel stepped down voluntarily after 16 years, of running Germany. Unlike the change of regime in the United States, it would appear that all of Germany came out of their homes and gave her a 6-minute ovation on the way out. I'll reserve comment, but it's interesting to see the change is happening all around the world. And it's interesting when you look at the change. A lot of the change is good change. When you look, as an example, at the march of technology, the incredible plethora of new products coming on the market to make your life and my life better. There's a lot to like in the world. And I would suggest that almost everything that there is to like comes out of the private sector, the free enterprise sector, particularly technology. There's a lot not to like in the world, too. There is a lot of discussion of increased taxation. Of course, if you look in the dictionary under the definition of taxation, and then you look in the dictionary under the definition of extortion, you'll see that there's not an awful lot of difference except for who does it and whether or not it's sanctioned. So there's a lot of things to be concerned about in the world. One of the things to be concerned about, I think, is the presumption by people that they have the right to prevail against other people through government. They have the right in their own minds to have their point of view win across others. And my suspicion is that most of the turmoil that we face in the world is a consequence of that simple misassumption. With regards to the economy, I would say more of the same, both good and bad. Equity prices continue higher, I believe, driven by artificially low interest rates, which lower the cost of capital to big companies and also increase the value of the income stream represented by dividends. So are higher equity prices a good thing? Well, probably. If you're invested in equities, they are a good thing. One needs to be cautious, though. I'm not forecasting an immediate crash, but I'm very nervous about a market whose underpinnings are artificially low interest rates. Even Warren Buffett, no fan of small government, has described artificially low interest rates as not a state of nature, but rather a construct of man. And my nervousness is that if there was ever a crisis of confidence of the style, as an example, that occurred in 2008, and the market ever lost control, or the government, pardon me, ever lost control of interest rates to the market, that you would see a contraction of value in virtually every asset class. So since you asked me a great big question, I gave you a great big answer.
So do you think that that's a realistic possibility of them losing control of interest rates, or do you anticipate them keeping it under control and moving towards yield control?
Jake, I know that your audience wants simple declarative statements. At your age, I did too. I've learned that simple declarative statements are almost invariably wrong. So I would suggest that people look at a crisis in confidence emerging, or a black swan occurring, or an increase in interest rates where the government lost control of the interest rates as an insurance, as a contingency worth insuring against, rather than as a certainty. That is to say, don't panic. Nobody can see the future, but keep it in mind as you construct your portfolio. Oftentimes in our past discussions, Jake, you have pointed out to me that the high cash balances that I advocate guarantee a loss, which they do. The amount of money that one makes in a savings account or in a bond or something like that, in any conventional savings product, guarantees that at the end of the year you'll have less spending power than you had at the beginning of the year. But having high cash balances in a circumstance where we hit into a period of liquidity gives you the means and the willingness to take advantage of volatility as opposed to being taken advantage of by volatility, which is why I would suggest that when we talk about extraordinary outcomes, either good or bad, that we understand that these are contingencies, that they fit into your plans, but they shouldn't be the core of your plan.
Understood. So for you right now, are you buying and selling? Where is your cash balance at? Let's get exact dollars to the penny here. So what are you doing?
My cash balances in the last 10 days have been decreasing because the extraordinary overvaluations that I saw in the juniors that we talked about last summer have begun to correct themselves. And so there are some speculative opportunities that I think are correctly priced rather than obscenely priced. That said, you will recall too that last summer I said the uranium juniors were dirt cheap. They're no longer dirt cheap. They've doubled. And I have begun selling some of the uranium juniors. It's my belief that with higher uranium equity prices, virtually all of the juniors are going to do private placement financings this year. And I want to make sure I have some dry powder available to participate in those that are attractively priced. Finally, the mid-tier in the gold sector, not the penny dreadfuls, not the $100, $200 million market cap, but rather the billion, $2 billion market caps, some lower, seem cheap to me in historic terms. When you look at these companies on an enterprise value basis, for those listeners of yours who don't know what enterprise value is, it's market capitalization plus cash minus debt, what you really pay for the company. If you juxtapose that number against the market capitalization and against free cash flow meaning cash that's distributable to shareholders after the sustaining capital necessary to maintain production, these stocks are the cheapest that I have seen in my 45 years in the business.
Wow.
And so because I believe the gold price and the silver price go higher, the idea that I can buy the mid-tier producers at the lowest valuation levels of my career means that I'm beginning to be able to allocate to the gold sector again. You'll recall in the summer that I said that I believe that while the gold price would go higher for a substantial period of time, gold bull markets often last a decade, that the gold equities were, in my own point of view, ahead of themselves. And you'll recall, too, that we talked about the probability, in fact, the certainty of cyclical declines of up to 20-25% in the equity indexes in the face of a secular bull market, which is to say a market that's going to go up 500% or 1,000% can fall 20 or 25% several times in the interim. Well, we've just been through that, I think. And I am using this circumstance to move a little bit of money around into the part of the sector that I find the cheapest. And I would urge your listeners to really pay attention to the mid caps, which are too cheap. If they don't go up of their own volition, I think they'll go up because they get taken over by bigger companies, either of which is good for you.
Interesting. And so you said 25-30% cyclical declines. Do you believe we're at the tail end of that, or do you think that there's more to come?
I think there might be a little more to come. The market seems fairly confident. It seems fairly sanguine right now. The big thinkers all believe that we're going to get a big stimulus check. I believe that too. And the big thinkers don't care too much about the long-term implications of that stimulus check. They care about its impact on sales and on investments. The big thinkers, and you know that I use that word advisedly, the big thinkers are mostly my age. And from their point of view, a circumstance where they enjoy the benefit now and your generation pays the cost is a very good thing. My generation can afford to be fairly short-term in their thinking because my generation doesn't have much time left. I'm being parenthetic a bit, but your generation has to be extremely concerned. You have to be extremely concerned. And in fact, members of your generation who don't have exposure to precious metals and precious metal stocks need to begin to build exposure in anticipation of 6 or 7 years left in a 10-year gold bull market, irrespective of whether they think they've hit the bottom. I'm not saying to buy a full position now, but to the extent that you haven't put your feet in the pond, you need to begin to do it because my generation is actively stealing your generation's progeny. And the only way that I know of that you can defend yourself against us is to prepare yourself to earn a non-contestable living and invest in asset classes that have traditionally protected yourself against the tyranny of the majority, or in our case, the tyranny of the aged.
Well said. I need a dictionary for some of those words, but no, I'm just joking. But so do you, right now, obviously, you were expecting a pullback. We got that pullback. You said you've been adding. You said, I think you even said in your 45 years, this is some of the most attractive pricing you'd seen in mid-tiers. Do you, and there's a lot of people that are starting now to go, it's not moving and every macro thing is in its favor, and so I'm going to sell it and buy Bitcoin, or I'm going to sell it and buy Tesla, and I'm done with this because it's a rigged market, or nobody cares about it anymore, and it's like a dinosaur project. What is your response to someone that is in that type of a sentiment that is now becoming discouraged by the lack of movement, where it seems all the fundamentals should be now moving it higher?
3 comments. The first is, and I've had to learn this painfully in my career, Jake, there's an enormous difference between 2 words in English: inevitable and imminent. And the fact that your psyche requires something to happen quickly is a fact that life doesn't care about at all. The idea that things have to happen in a time frame that's convenient for you or your psyche is a very damaging investment thesis. The chart that I talk so often about, the Barron's Gold Mining Index chart, is one that the impatient people should study. It takes a substantial period of time to make a substantial amount of money on a probability. And people need to acquaint themselves with the expectations that are reasonable as opposed to the expectations that they have. Most people lose money because they focus on the expectations that they should have rather than doing the necessary studying to furnish themselves with a set of expectation that's realistic and can make them money. The second part of this is the hilarity of financial assets. If your wife went to the store in Utah and she was used to buying, let's say, tuna fish, canned tuna fish for your family because you like tuna fish sandwiches, and a can of tuna fish that she was comfortable buying at $2 was suddenly selling in the store for $3, that is to say the price moved, she would be furious. She would buy canned chicken or canned salmon or something like that. By contrast, one of your impatient young listeners who bought a share of stock at $2 and went back to the stock brokerage the next week and saw it at $3 with no change in the underlying fundamentals would be delighted. Absolutely delighted. In other words, the fact that he or she could pay 50% more for the same item in a short period of time would make it to them more attractive. This is insanity of the highest order. Carry this over to Bitcoin. If Bitcoin had utility at $10,000 and nothing has changed with the Bitcoin, in fact, they've issued a little more of it, and it's now selling for $20,000, it is precisely half as attractive. Price to utility, and people are delighted. Conversely, If you believe that the value in Bitcoin is the value of the network, the value of anonymity, the value of frictionless trading, and the price goes from $20,000 a coin to $10,000 a coin, it is precisely twice as attractive. This is really simple arithmetic that people who rely on narrative and intuition always get wrong. Now, increasingly, Jake, in my declining years, I have to be thankful for other people getting stuff wrong, because occasionally they make catastrophic mistakes that allows my life, if they're not my clients, to be easier. That seems like a very selfish attitude. But since it's inevitable and somebody has to win, from my point of view, that may as well be me or your last guest, Doug Casey.
Interesting. So over 2020 gold price, I think it went up like 19.6% or something like that. Do you anticipate movements like that, another maybe 20%, or do you think that there's explosive moves, or are you more in the camp that it's like 20, 20, 20, 20, those types of movements?
I set my expectations conservatively because I prefer that my actions have a conservative premise. The truth is, when I look at the landscape, when I look at the circumstances that confront gold, when I look at quantitative easing, when I look at debt and deficits, when I look at negative real interest rates, and when I look at the fact that gold is under-owned relative to the last 3-decade means, I, in my heart of hearts, believe that gold is likely going not higher, but rather much higher. I don't allow my philosophical predisposition to govern my wallet, which is to say that I view my bias as interesting rather than relevant. Given that I think that the preponderance of evidence is on gold's side and on the gold equities side, and given the extraordinary lessons taught by the Barron's Gold Mining Index chart, I am heavily invested in gold. Let's say for fun, Jake, just for fun, let's say that gold was going to go up 20% this year, and let's say it was going to go up 20% next year. History teaches us that the gold equity index outperforms gold by as much as 100%. Sometimes more, actually, but over the course of a market, by as much as 100%. That suggests that the gold equities could be up 40 or 50% this year, and 40 or 50% again next year. A 45% compound internal rate of return, using relatively reasonable assumptions, is probably all anyone has the right to ask for. I understand that young people are drawn to the sector in particular, and old people are lured back into the sector by visions of things like Pan American silver from 50 cents to $45. I get all that. But the only way that you're going to enjoy the move from 50 cents to $45 is, first of all, if you plan on holding the asset class for 5 or 6 or 7 years, which is what that move took. And secondly, if you can stomach more than 20% declines. If my memory serves me right, 4 or 5 times during the duration I held Pan American silver, the share price fell 50% or more.
Wow.
Which is to say, owning the stock from the time that we financed it at 50 cents a share to $45 a share, on 4 or 5 different occasions, the share price of Pan American fell by 50% or more. This was a rodeo ride. And your listeners who want to enjoy those type of speculative gains have to understand that they're taking speculative risks, that they need to be much more patient than they believe that they need to be, and that they need to be psychologically prepared for volatility, lots and lots and lots of volatility. And if you aren't financially and psychologically prepared, you aren't going to make the money. You're only going to experience the risk.
Okay, so let's talk about how you do that. You know, judging by reading my comments, you know, I mean, I'm really trying to make this, my goal is to make this the most valuable commodities channel on YouTube. and really a training that really helps people. And, I think that that's something people are commenting a lot and having difficulty with. So let's talk about how would one prepare themselves better financially and psychologically, as you said?
Two immediate tools, Jake. The first would be all of your listeners, all of them, should read a book, The Intelligent Investor by Ben Graham. They should read, in particular, the chapters on margin of safety, which is about not losing money, which is part of making money. And the second part is Mr. Market, which talks about individual psychology and mass psychology, and why most investors and speculators are losers, manic depressives and losers. So all of your listeners, don't just buy the book. You got to read the damn book. I've been giving interviews like this for 40 years, and I've probably sold 10,000 copies of this book for Graham. And I suspect 8,000 of the 10,000 have gone unread. So buy the book and then read the book. The second thing that occurs to me right now is that at some point in time, you and I should do an interview where rather than you focusing on your face and my face, that we focus on the 50-year Barron's Gold Mining Index chart, where we examine, and I'm not saying to use it for technical analysis. I don't care about double bottoms and rounded tops. Well, maybe I do, but in a different subject. But as an illustration of the cyclicality of the precious metals market, and an illustration of the volatility of a gold market, and actually as a teaching tool to look at the anatomy of a gold bull market. I think perhaps if your listeners who were more studious paid attention to a session that talked about, in a visual sense, the anatomy of a precious metals equities bull market, that they might be better prepared. Now, the truth is that between your two channels, you have an enormous audience. And sadly, for you and for them, Pareto's law prevails, which is to suggest that out of your audience, probably 20% will get it. And probably 20% of that 20% will get it well. That doesn't mean that you shouldn't try to help as many people as you possibly can. It's that you should understand, as a channel owner, that your ability to cause people to learn when they're learning a verse is very small. But the truth is that the numbers that you're talking about are such large numbers that I actually believe that you have the ability to make the world a slightly better place for a reasonably large number of people, which would be fun.
All right, cool. Yeah, let's definitely do that. Next time we do it, I'll do screen share, and I can before we'll check in. Everyone, comment down below if that sounds good. Leave a comment down below and say Rick Rule rules, or let us know if that sounds good. And then
understand, this won't be clickbait. I'm not going to give you any flashy headlines. This is actually doing the work. Okay. This is actually like blocking and tackling on a football field, but it's where money's made. This is not about narrative. This is not about emotion. This is not about headline. This is about profit. It's a very different process.
Okay, yeah. Why don't next time, in addition to that, any other charts, and I can pull them all up into Keynote, so then I can flush them out. So then let me ask you, if you're speaking for fun, what do you think is going to be the best performing asset in the natural resource commodities, including metals, of 2021?
Risk to reward, I think, precious metals. Best performing asset class would be, well, it might actually be a scam. It might actually be the battery metals. It might actually be the rare earths that nobody can pronounce. Because if you limit me to a 1-year time frame, mistakes can outperform good, solid work anytime. And we're in a very narrative-obsessed market. So it could very well be all the little unpronounceable materials that allegedly have applications in battery, up to and including, say, lithium. In terms of investable themes, by the way, I think that lithium is an investable theme, but not the way most people do it. In terms of investable themes, I think investors need to focus in 3 places. 1, precious metals. I think it's probable that they go higher. I think it's probable that while there might be a bit of downdraft left in the equities, that they're reasonably priced and going higher. The uranium stocks are ahead of themselves and need to retreat, but we are beginning to see the circumstance where the long-term contract market reasserts control over the short-term spot market, and that's higher. And higher uranium prices will really, could really propel the shares of uranium equities. Will it happen in 2021? I don't know. I suspect by the end of 2022, we'll look back and say, what on earth were we thinking about not pounding the drum on uranium? And then finally, oil and gas. Oil and gas is a great big sector. It's a wonderful sector. Biden doesn't like it. I don't care. Greta doesn't like it. I don't care about that either. The truth is that when the majority of your readers and listeners walk out of the bedroom in the garage and turn the key to the right, they want their car to start. And if the oil price doesn't descend to the total cost of production, their car won't start in 5 years or 6 years. And frankly, if the price of natural gas doesn't go up to cover all the costs producing natural gas, before they get to the garage, when they go to the kitchen and turn on the stove, the coffee won't get hot either. So I think that your listeners and readers, when they talk about oil and gas, have to ask themselves which set of circumstances is the most probable. The price of oil going to $55 or $60 a barrel, or their car not starting.
I think that sounds about good to me. Okay, so we got uranium, we've got metals, and we've got oil.
Conventional energy. Yep.
Conventional energy. Okay, so that sounds about good to me. So uranium, to you, it sounds like more is it's an unsurety of when, but it's an importance to hold.
Yeah, two comments there. Your listeners need to pay attention to the real uranium companies in addition to the little ones that have the potential for outsized gains. These aren't securities recommendations, but your listeners need to begin to study companies like Cameco, Kazatomprom, and China General Nuclear, or CGN Mining, to understand how the uranium business works. I'm not saying to buy them or not buy them, but you familiarize yourself with the sector by studying the biggest and best companies in the sector. If you are buying purely the uranium market, at some point in time, you buy those because unlike the guys looking for uranium, these guys will benefit immediately from higher prices because they produce it. And then you use the knowledge to come down market. For those of your listeners and viewers who are accredited, which is to say $1 million net worths and able to participate in private placements, my suspicion is that every viable uranium junior in the world will need to raise equity this year to stay alive until the price rises and to get their projects shovel ready so that when the price does rise, they can take advantage of it. I think that there's going to be an absolute feast of uranium private equity placements in 2021. And I'm just sort of rubbing my hands and almost salivating in anticipation of that. It isn't where your listeners should start. Your listeners should start with the biggest and the best, getting, as an example, a dividend yield to make them a bit more patient while they wait for the circumstance to occur. But for those people who are incurably speculative, like myself, and are willing to take the risk and can stomach the volatility, I think we have an unusually attractive situation in front of us, analogous to 2001, 2002 in the junior uranium private placement market for those of your listeners who are qualified as accredited investors.
Interesting. So let me ask you, for someone listening to this right now that, wants to be, they look at what's happening right now and they look at the devaluation of currencies and they look at the infinite money printing in this, preposterous macroeconomic climate. And they say, here's my chance to get freedom and to be a mini Rick Rule, to be a mini Doug Casey. And this is my opportunity. What personal or financial advice do you have to an individual like that is looking at what's happening right now in the world and wants to seize this opportunity of freedom that, is you and Doug kind of have the war stories and everyone knows, and looks up to your guys' story, and they see it as their chance and time for it?
Invest in yourself first. Doug Casey built a business around Doug Casey, and he built a business by reading, and I'm not kidding you, 6 to 8 to 10 hours a day, and by writing 6,000 words a day. Yes, Doug Casey had the courage in the early 70s to buy South African gold stocks. And 3 years after he bought them, they were paying dividends that were equal to his purchase price.
Wow.
But he had the ability to do that because he invested in Doug Casey that generated some income. And he invested enough in his intellect that he was willing to buy the South African gold stocks in the face of apartheid, in the face of labor unrest, in the face of low gold prices, in the face of high sustaining capital investments, when nobody else was willing to buy them. So your first step is to invest in yourself. Sounds boring, probably. Probably what you want is for me to give you a 10-cent stock that's going to go to $10. But the truth is that I don't know any 10-cent stocks that I'm sure are going to go to $10. What I do know is that if Jake Ducey continues to invest in making his website and platform the most invaluable source of information on personal development and on investing for his generation, that irrespective of what happens to the gold price, Jake Ducey is going to become stupidly rich. And that his return on speculation is going to be the icing on the cake rather than the cake itself. The second thing is common sense. Pay attention to your downside, not just your upside, which is to say, use your education to determine which of the paradigms that you hold are narrative-based and which ones are based on science and arithmetic. And pay attention to the ones that are based on science and arithmetic. It takes time to make a lot of money. It took Doug Casey the decade of the 70s to take himself from a not too good insurance salesman and school teacher to being a multi-millionaire guru. It didn't happen in 18 months. Yes, he wrote a couple of books that were best-selling books, but even the process of writing those books took 18 months to 2 years. If you look at the ascent of Doug Casey, what you will learn is that Doug spent 20 years preparing for the ascent of Doug Casey, and then he spent 10 years on the ascent of Doug Casey. So bear in mind that the ascent of Jake Ducey and the ascent of Jake Ducey's listeners, unless they're materially smarter than Doug Casey, which, knowing Doug as well as I do, seems unlikely, that applying common sense, hard work, and patience are what's going to be required. I think it's important, too, that increasingly, unfortunately, we need to ignore conventional news sources, except as a source of understanding how broad groups of the population think. Before I came on with you today, I was scrolling through the online versions of NBC and CBS and MSNBC and Fox and all of those, and I was struck on the websites, by how little news they carried, by how much entertainment there was in place. I understand that any good that's free means that you are, in fact, the good that's on sale. And those major news sites need to make themselves outrageous enough, pablum-like, and entertainment-oriented enough that the idea that you would rely on them to shape your opinion of the world and the way that the world is going to behave, I think is an important mistake. I think you need to pay attention to the broader news sites so that you get a better sense of how society thinks and why. But I think increasingly, more so than at any time in my life, You need to do your best to inoculate yourself against groupthink.
Interesting. Did you see that Hunter Biden got a bagel yesterday?
I must say that having looked at 5 sites, I didn't click on any articles. None seemed useful enough to me, frankly, to waste my energy to draw it up. It was clear to me that the news is being packaged and delivered to me the same way that I Love Lucy used to be.
That's funny. Yeah, I saw this article yesterday, and the headline was Hunter Biden gets a bagel. And that's what it was about. But let me ask you, knowing everything that you know, and on top of everything you've learned and everything you've done, you've also been around a lot of very intelligent, very successful people. I mean, obviously Doug's one of your best friends, and you learned a lot from him. But I mean, I'm sure a lot of your clients are really very intelligent, interesting people, maybe very successful business people. So you've learned a lot, and you've learned a lot about success and freedom. Let me ask you, if you were 20-something, 30-something years old right now, and you, in our world literally today, with all this crazy stuff happening, what advice would you be giving yourself?
Myself, because I'm pathologically curious. Pathologically curious. I would probably begin by doing what you're doing. I have a communication gift like you do. And I would probably look for broadly held precepts that were true, but not widely believed. And I would make it my business to translate complex topics and make them easier for people to understand and gather a following. I also, ironically, wouldn't go in the resource business. I went into extractive businesses because I was fascinated by them, loved them, which was a good reason. But in my experience, I've learned that the topic that interests me the most is risk and the price of risk. And were I your age, I would go into a business that more fully explored discounting risk, which means to say that I would go in not as a salesman, but rather an investor in the insurance business. I would loan my balance sheet against contingencies, which is to say I would accept people's premium payments in return for helping them save against catastrophe. At the same time that I would then invest those premiums in assets that other people considered risky that I considered to be less risky. I would arbitrage risk on both the asset side of my balance sheet and the liability side of my balance sheet. But that's extremely personalized advice. You need to find something that you do better than other people. You need to find something where you add utility. I've told you before, Jake, when I stopped worrying about making money at all, and started worrying about delivering value to other people, irrespective of how I got paid. Within a quarter, I started making money that would have been earlier in my life incomprehensible. It's really odd that when I stopped focusing at all on making money, and I started focusing on delivering value, I immediately began to make not merely more money, but a quantum more money.
Why do you think that that's so hard for people to grasp in this idea of how to make more money and thus providing more utility?
I think people are probably focused on themselves and the process of making money a bit too much. And by the way, when I say this, there are a lot of people for whom making money isn't important and probably shouldn't be important. There are lots and lots and lots of aspects in life other than making money. I wanted to measure myself against other people. I'm competitive, and an easy way to do that is regards to money. And I was brought up in a household where by the end of the month, there was either very little or no money. And I wanted the security, as Doug Casey says, to be able to go into a restaurant and not even have to look at the right side of the menu where the prices were. Now, the truth is, because of my upbringing, I will never be able to do that, but it's a wonderful idea. So I wanted the psychological freedom associated with money. I wanted the physical freedom. I wanted to be able to do what I wanted, where I wanted. And I liked the measure. There are other people who need to earn enough money so that they have leisure in their life and they can pursue other courses of happiness. All of that's great. All of that's great. But to the extent that some part of your plan involves having sufficient money, rather than focus on how you're going to make the money, focus on how you can deliver value. Savings, really, are the excess of utility generated over utility consumed. That's what they are. What you use your money for is stuff that you want or need. You get the money by providing other people stuff that they want or need. So if you think of the process as accumulating wealth as a function of generating more utility than you consume, you understand the whole of the subjects.
Beautiful. Okay, so I know you're a busy man, so we'll wrap up here in a minute, but let me ask you, what are the most important philosophies that guide your life, either professionally or personally?
Volition, individual will. The most important book that I ever read in my life was Human Action by Ludwig von Mises. And understanding individual will, individual liberty, understanding that your relationship with society, if it's honest and honorable, is voluntary, and their relationship with you is honest and voluntary, has been the way that I came to make myself comfortable with and accommodate any relationship that I might have with society or other people. I didn't understand how people interacted or why societies or groups or companies or communities failed until I came to understand volition as expressed by Ludwig von Mises in Human Action.
Interesting. Okay, so last but not least, let me ask you, what are you most excited about or looking forward to right now in your life?
To be honest with you, the thing that gives me the most pleasure is doing this. Listen, Jake, I love the process of making money. But the truth is I can do it like falling off a log by now. That isn't to say that every quarter I come out way ahead, because I take a lot of risks. The nature of what I do it involves taking a lot of risk. I enjoy not so much building businesses, because I'm 68 crowding 69, and building a business takes 10 years. And I'm not sure that I have 10 cognitive years left. But I enjoy helping other people build businesses. I enjoy that a lot. So this is the process. I'm, as you know, moved into a new home with a wonderful office that I'm sitting in with a view across Puget Sound looking at Mount Baker. And the idea that I can do what I do, that I can employ the lessons that I learned in the last 45 years, employ the capital that I've earned in the last 45 years, from the comfort of my own home, surrounded by a community of friends that I've built up over 45 years. It's difficult for me to imagine a better life than the one that I have. It's really a truly wonderful set of circumstances. I try, frankly, not to get myself too comfortable. Every now and then, I think about the challenges that are left in the world that I might be able to help address. It would be perfectly easy for me to default to a life of reading online, walking out and chopping wood, which is how I get my exercise, sitting in my office and enjoying a fire with the wood that I just chopped. I make myself understand that there are young libertarian students in Rwanda or Nigeria who could benefit from my life's lessons and might not have any other place to learn those lessons than from me. I understand that there's a whole crowd of millennial investors and speculators who are going to inherit from my generation $140 trillion in debt, whose life might be improved by absorbing some of the lessons that I have learned in my life without having to make some of the mistakes that I made in my life. So the part of my life that's interesting is not so much building businesses for myself anymore, but rather helping build businesses for other people, particularly if they allow me to invest in those businesses, so that I get some tangible benefit from it. And the fact that I really truly enjoy teaching, and the idea that I can get paid almost incomprehensibly large amounts to teach is a really truly wonderful set of circumstances for me, Jake.
All right, I can dig it. So for everyone listening, next time we have Rick on, we're going to pull up some charts. We're going to make it a little bit more of a teaching setting. If that sounds good to you, please let us know in the comments right there down below. Comment down below, Rick rules. So I'll pass it back over to you, Rick, for your offer.
Yeah, two commercial announcements. The first is I've really enjoyed assisting your listeners in investing. And there's no way to enlist somebody's interest in investing better than commenting on their existing portfolio. It focuses their questions. So any of your listeners who go to the link that you have down below, sprottusa.com/rankings, if you enter your natural resource stocks, please no technology stocks, please no pot stocks, your resource stocks, I will rank them 1 to 10, 1 being best, 10 being worst, and I will comment on individual issues where I think my comments might be important. In addition, if you mention chart in your request, I will send you the Barron's Gold Mining Index chart, and I will send you a 100-year commodity chart, which will talk about how cheap other commodities are. If as a consequence of other things, the part of the discussion today about uranium private placements is of interest to anybody, also mention uranium/accredited so that we can put people on our list so that if we have availability of high quality private placements in the uranium space or other places, that we can notify those listeners of yours who are interested, able to afford the risk, and are willing to participate.
Absolutely. Okay, so for everyone listening, please make sure you hit the like button on this side. Make sure you subscribe, hit the bell notification, and we'll be looking forward to next time when we break down some charts and some more visuals from Mr. Rick. So thank you for joining, Rick.
Thank you, Jake. Enjoyed it.